So in other words, to get the debt problem solved, what they really have to do is to get the exchange rate down significantly. And that's not going to be an easy task. First of all, because it involves great loss of face. And secondly, because I'm sure there would be tariffs imposed or further tariffs imposed, probably even beyond what Trump is contemplating on China if he decided to devalue the yuan significantly.
Hi guys, welcome once again to The Pragmatic Investor. My guest today is Michael Howell. You've seen him on the show before. He's an absolute must follow on Substack, an expert when it comes to macroeconomics and, more importantly, market liquidity, one of the most important, if not the most important, indicators in global macro. Now today I got the chance to sit down with Michael and talk about his outlook for 2025, what he thinks about liquidity in the coming year, how he's thinking about the outlook for macro, inflation, and all the things that may have changed now that Trump has been elected president. I really enjoyed this conversation with Michael. As always, he's just incredibly knowledgeable when it comes to liquidity dynamic. With sentiment and the market getting so bullish in the last few months, I really wanted to get Michael on the show to tell us what he really expects to happen in 2025 and beyond. Some very interesting insights in this chat, so please go ahead and check it out. If you haven't already, follow Michael. He's on Substack, Cross-Border Capital, also on Twitter. Links will be in the description. And of course, if you're not already following The Pragmatic Investor, please do so. I'm on Substack and on YouTube. I do macro, technical analysis, and fundamental analysis. As always, I hope you enjoy this conversation as much as I did. All right, welcome back again to The Pragmatic Investor, and we have with us again Michael Howell from Cross-Border Capital. Michael, thank you so much for joining us again.
Hi, James. Great pleasure. Lots to talk about. Interesting times.
Absolutely. Of course, there's been so much happening since our last conversation. Of course, for anyone interested in catching up, we did have an interview a few months ago. We talked generally about liquidity and also the outlook for liquidity. Now, of course, I'm just going to give basically a brief summary of what liquidity is, and then, of course, Michael, you're the expert, so feel free to correct me or add anything to that. So basically, we were discussing liquidity, which is, of course, your area of expertise, something which is a very important macroeconomic indicator. It could basically be summarized, I guess, as the general flow of assets, let's say, within financial markets. So, of course, we'd say that when liquidity is increasing, that obviously lifts the price of assets. When it's decreasing, it obviously brings down the price of assets, kind of in general terms. And of course, I know that you have a certain vision of a liquidity cycle and basically how that affects markets. Am I in the right ballpark there, or is there anything I'm missing out?
Yeah, broadly, I think that's absolutely spot on. Liquidity is a global concept because liquidity is fungible between markets, particularly with open exchange rates. And we measure it as the flow of credit and savings through world financial markets. I mean, it's worth stressing that two things, I think. One is that we don't pay a lot of attention to traditional monetary aggregates like M1 or M2 because they're really measuring money in the real economy, which is not our great interest. We're interested in the flow of liquidity or money through financial markets. And the other thing is that interest rates really play a secondary role in this whole thing. It's all about understanding balance sheets, balance sheet capacity, and particularly balance sheet capacity of the financial sector.
Mm-hmm. Of course. And of course, that issue of always, the idea that we basically live in a refinancing economy, right? And that basically that need to always keep refinancing and how that maybe impacts markets, which kind of brings me to my next question. And of course, we'll start straight at where it matters. What's happening to liquidity right now? Because I would say last time we talked, you generally spoke quite bullishly about liquidity. I've seen maybe some of your latest work talking a bit about more bearish trends we've seen in liquidity. What are you seeing with liquidity right now?
Well, let me try and share a slide, if you can see this. This is looking at our global liquidity cycle. This is measuring the momentum of liquidity through world financial markets. You can see on the chart the black line, which is the index, and that index is designed to range between 0 and 100 with a 50 mean. It goes all the way back to 1970. The red dotted lines are a sine wave that are drawn on top of that, and that sine wave basically fluctuates with a range of about 5 to 6 years, or as it says there, exactly 65 months. And that pretty much captures the tenor of that cycle, or frequency of that cycle. So what you can see is the cycle goes up and it comes down. The last major bottom was in 2022. In actual fact, it bottomed in September, October of 2022. And this bull market in liquidity has pretty much coincided with the bull market in risk assets. So liquidity has basically jumped higher. As you can see from the chart, liquidity doesn't always go in a straight line. I'll come on to that. But basically, the trend generally seems to be upwards. And it looks as if it's slated to peak out sometime around about, or sometime in the second half of 2025. So we've still got, some months to go before the liquidity peak. The concern we've got is that basically liquidity, if this is a liquidity supply, there are increasing demands on that liquidity as 2025 unfolds. And I would really cite three of those to be paramount. One of those is higher underlying inflation. So we rather think that core inflation, if you like, in the US is much nearer 3.25%, than the sort of slated 2.25% that we're told by the Federal Reserve and other commentators. So we think there's a higher embedded level of inflation there. That may not be catastrophic, but clearly it's absorbing more liquidity, and it may be restraining, some of the more dovish Fed governors from slashing rates too much more. Mm-hmm. The second thing is that China is a major, major uncertainty, and there is a risk that the Chinese economy doesn't recover. There is a risk that this whole debt crisis in China becomes worse. And as a consequence of either one or the other, there could be increasing demands on dollar financing. And the reason I say that is that actually China, for all the talk about the renminbi or the Chinese yuan currency, China is de facto a dollarized economy. The US dollar is very, very important. A lot of Chinese trade is denominated either directly or indirectly in US dollars. And Chinese banks have very large gross positions, both in asset and liability terms, in the US dollar. So the dollar matters hugely for China. And you can just see the paradox unfolding very often, that when China has a rising trade surplus, it tends to coincide with a stronger dollar, not a weaker dollar, as the textbooks would tend to say. The third thing is that, as you mentioned earlier on, we're really looking here at a refinancing cycle. Why is that cycle 65 months? In other words, between 5 and 6 years. I would venture because that's the average maturity length of a debt instrument. And what this cycle is really reflecting is a refinancing cycle of that debt. And therefore, we've got to think about when the next wave of refinancing is coming. And one of the concepts that many people may have heard of is the debt maturity wall. Now, the debt maturity wall is a concept that is used to describe the maturing or bunching of debt maturing that was taken out during the very low interest rates in the period around the COVID crisis. Now, many corporations, households, and even governments decided to term out their loans, and rather than go short term, they basically pushed maturities longer because they could at low interest rates, and therefore a lot of the debt was bunched around 2026, 2027, 2028, and it's beginning to seep back into the system now to be refinanced. And that, we think, is going to start to affect markets from about the middle of 2025. So there's a lot of debt to refinance. I mean, to put this in context, displaying averages, there's $350 trillion of debt out there in the world economy, with an average maturity of, let's say, 5 years to make the math easier. That means you've got 70 trillion of debt to refinance every year. And to refinance that huge, huge volume of debt, you need balance sheet capacity among your banks and credit providers. And that is what we define as liquidity. So liquidity is being challenged on these three fronts. So what you can see here is the cycle looks as if it's intact. It looks to be, carving out what for all intents and purposes is a normal cycle. But there's volatility. And that volatility, as I'll explain in a moment, is really coming down largely to what's happening in China. And I'll just give you one piece of evidence on that. And that can be seen if we look at the next slide. which is the same global liquidity cycle, but only for the advanced economies. So we take China and the emerging markets out of this. And what you can see in this particular version of the global liquidity cycle, purely looking at advanced economies, it looks much smoother than the previous one. So if you go back, you can see there's a lot of volatility, particularly recently, and that's really because of what's happening in China. So China, we've got to keep our eye on, and I can say a little bit more about that, maybe later.
Mm-hmm. Very interesting. You actually bring up some points that were recently also made by Stanley Druckenmiller. I don't know if you've seen his recent interview. He had about an hour-long interview, of course. A lot of people interested in what he had to say. He exposed a lot of his thoughts. Obviously, first of all, of course, the idea that the economy is really strong. That seems to be kind of a consensus right now. Of course, who could argue with that? Plus we've got this great Trump rally going on. But, it looks pretty good. Inflation's coming down and the Fed is cutting. So first of all, I guess a couple of thoughts here. First of all, how do you see the economy overall in terms of strength? And secondly, since we talked about inflation, now Druckenmiller, for example, exposed the idea that, for example, the Fed is making a policy error here by cutting in a situation where, well, first of all, perhaps already inflation is higher than it seems, and that perhaps there is a chance that inflation is going to bounce higher. So is that something that you agree with? Is the Fed making a mistake, and is a resurgence in inflation a lot more possible maybe than we're pricing in right now?
Well, I think there's a number of ways to answer that. I mean, one is I think you've got to differentiate the economy that we see now from the economy that may evolve under a Trump presidency, because I think there's another factor to bring in here. Should the Federal Reserve act in some way to try and offset or maybe mitigate what would likely be a looser fiscal policy under Trump? And I think the answer to that is surely it should do. Okay, but let's leave that to one side. I think as we stand now, my answer to the question really depends on what the Fed is trying to do. If the Federal Reserve is trying to cap inflation, then the answer is yes, they should be a lot more circumspect about cutting rates further. And in actual fact, as I said, I think if you look at underlying inflation in the US, it's probably at least 100 basis points higher, probably nearer 3.5 than 2.25%. That sort of magnitude. Now that may not be a disaster, but it's certainly a lot more than the Fed is claiming. And it's wrong to say that they've actually won a big victory over inflation. They've done well, but it certainly isn't beaten. So I think there's that point to make. I think, on the other hand, if the Federal Reserve is not so concerned about inflation, and that would actually be my feeling, they're much more concerned about the integrity of the bond market, then the argument is they've probably got to keep cutting. And one of the problems that you see, which comes back to this whole debt question, is that the US Treasury has to roll over about 1/3 of US outstanding debt in 2025. Now that's, an eye-wateringly large amount of debt to refinance. That's across the curve. A lot of that we know has been recently Treasury bills. But the argument that I put is that the average interest rate on the existing debt in the US is about 2.8%, on government debt, about 2.8%. The average interest rate prevailing across the yield curve right now is nearer 4.3. So if they're refinancing this debt, they're going to have to refinance at higher rates. And that by itself, just looking at the math of that particular roll, will probably add something like 20% to the interest bill. The interest bill is already circa $1 trillion. So you're talking about 1.2 trillion for starters next year, even assuming you get no change from here in interest rates and no significant increase in the debt burden. So the maths are really working against the authorities, and therefore maybe what their real criteria is to try and cap interest rates at the long end. And my view would be that actually the policy rate in the US has changed now. It's not really Fed funds, it's actually the 10-year note yield. And that's what they're really trying to control. And if you look at all their activities, I would argue that a lot of the actions that Janet has taken at the Treasury recently, in terms of a lot of bill issuance is now 22% of total US debt. It's come up a long way in the last 2 or 3 years. And there's been a focus on issuing a lot of debt at the shorter end of the market as well. In other words, the average calendar has dropped by about 1.25 years in the last two. In other words, the average bond offered in the calendars is now a maturity about 1.25 years less than it was 2 years ago. So there's been this big focus on the short end of the market. All these actions, we think, take around about 100 basis points out of the long end of the market. In other words, yields should be nearer 5.25% rather than 4.25%. So you get the idea that there's a lot of upward pressure on long dated yields. Therefore, there's pressure on the Federal Reserve to keep interest rates down to cap that interest bill. In other words, what we've got, as I describe it, is you've got not yield curve control going on, because it's a very unconventional form of yield curve control. But hey, they're doing it.
Right, Liz. Like you say, they've been kind of playing around with this idea, and it's in very typical Fed fashion, right? First, there's not QE, and then there's not yield curve control, right? But it's definitely very interesting. Like, for example, we do know that Druckenmiller, for example, has a short position on bonds right now. And it's very interesting what's happening, right? In terms of interest rates, of course, a lot of people would have expected that as yields on the short end got cut, we'd see yields come down on the long end. That hasn't happened. We've seen high and high yields. This has happened also at the same time as, for example, the US dollar has been going up. We've seen while gold keeps climbing, while basically kind of everything goes up at the same time. It's something quite unprecedented, I guess, from kind of cross-asset type of dynamics. So what do you think is going on, especially in terms of defining those yields? I mean, if you think that, so you believe then that the natural rate should be, let's say, or perhaps not the natural rate is the right word, but that the actual rate should be higher and that therefore we are going higher? Is that?
Yeah, I think we are. I think we are going higher. I think it's very difficult for the Treasury and the Fed, even despite their given the firepower they've got, to actually hold yields down. I think the general trend is upwards. And you just got to look at pressures on term premia. Term premia are a wonkish concept, but they're basically the risk premia the risk premia that investors get for holding interest rate risk on a bond. They, on our estimation, are still negative, and they should be positive, and they probably should be sizably positive given the outlook we've got and given the amount of coupon issuance that has got to come over the next 2 or 3 years. The fact is that the Treasury can, well, cheat is the wrong word, but it can basically bend the rules by doing a lot of short-term bond issuance and bill issuance. But that's a short-term palliative. At some stage, they've got to issue coupons, unless they turn the whole US debt pile over to Treasury bills, but that would be a disaster. The great risk in this environment of basically going very short term is your interest bill the Treasury faces, which of course is again funded by more debt issuance, is very, very sensitive to short term interest rates. So if you get a situation, which is why I think the Fed would be probably wise in a way to try and get rates down here, is that if you see a situation whereby there is upward pressure on interest rates, the interest bill will just rocket out of sight. And that's really the problem that they're getting into now. So interest rates really become far, far less of a monetary policy tool, or an effective monetary policy tool. You simply can't use them. What's more, you've got to say as well, which I think has been our experience over the last few years, is that these huge amounts of debt and these large interest payments that are being made from the Treasury through to the household or corporate sector in the US, this is a massive income transfer. So in actual fact, one could actually say that higher interest rates are actually stimulating the economy, because broadly speaking, the Treasury is just writing checks and giving them to people. So interest rates don't work as a disciplining tool that economists once thought. They're actually a stimulus, perhaps.
Mm-hmm. Yeah, absolutely. Yeah, that makes a lot of sense. And also within that idea, of course, of fiscal dominance and those interest rates actually kind of creating more of a wealth effect in some way. So, of course, on one end, then you have the interest rates going up. Of course, you would say that is maybe pushing up also demand for the dollar. And that is, of course, we could say, let's say, in terms of liquidity, subtracting from the liquidity equation. Is that the simple way?
There's no question about that. There's no question that that's true. A stronger dollar is negative for global liquidity. I mean, that's unambiguous, and that's something that we've got to be concerned about. It was my view that what would happen would be that the Treasury and the Fed somehow would engineer a weaker dollar over the next few months or over coming months. That hasn't happened. The dollar is strong. I think that the background for the Trump election is likely that the dollar could get stronger. And it seems that the Fed is not inclined to maybe cut rates as aggressively as people once thought. And therefore, you've got this problem of the rising dollar. And I can demonstrate that. I'll try and demonstrate that with another chart if I can. Let me just go back to my presentation and do this in terms of a right. Let me just try and show you the I'm going to right. Okay. So let me just demonstrate the dollar. There's a lot of charts here. I'm not going to show them, I promise. Right. Okay. So if we start to look at the dollar, which is coming up here. So this is a chart of what's called the real trade-weighted dollar index. And what this shows is the trade-weighted dollar, in other words, the DXY index, but adjusted for relative prices. So it takes into account inflation. And this is a much, much purer guide to the underlying competitiveness or productivity capital flow performance of the US economy. And what you can see on the chart, clearly evidenced back to 1964 when the chart starts, is a long period of dollar decline right up until probably the global financial crisis in 2008-9. Then the dollar starts to move substantially higher and breaks that long-term downtrend and starts to form a strong upward channel. Now, that upward channel is largely the result of a number of features. One of those is that in the wake of the GFC, there was tremendous regulation or re-regulation of banks and insurance companies worldwide. And one of the assets that they were encouraged to buy was safe government bonds, particularly US dollar government bonds. So it increased the demand for dollar safe assets significantly. The second thing was that in 2010 through 2012, there was the Eurozone banking crisis, which pretty much was the nail in the coffin of the euro being a major international currency, in my view. And a lot of investors who were prepared to accept the euro gave up and went back to the dollar. And the third thing was around 2015, 2016, there was a major anti-corruption drive in China, which pushed a lot of Chinese money into US dollars. And all those features are basically there, evident in the chart. And what's more, productivity performance in the US economy was underpinned by the technology boom. So I think a lot of those factors remain in place. Now, if you look at that up channel, it's very, very difficult to argue that there is evidence at all that the US dollar is set to weaken. You could argue it may fall towards the bottom of that channel, but then equally I could argue there's a good case that it might go towards the top of the channel. But it seems to be in that uptrend. And one of the reasons that's happening is that there's strong capital inflows into the US unit. And what this chart here is demonstrating is the pattern of inflows into dollars. And these are our estimates using many different countries' data of what goes into the dollar. But it principally shows that since the global financial crisis or there or thereabouts, there's been a very strong uplift in the amount of money that's going into the dollar at an annual rate. And even though the momentum has recently been lost from the peaks, there's still a net flow. And what this chart doesn't show is November, when one would imagine that a lot more money has gone in because of the Trump election victory. So all these things are really backing, what's happening to the paper dollar. Now, because the paper dollar is likely to be stronger in our view, that does not necessarily mean that the dollar will rise against Bitcoin or rise against gold. It's more likely that some of those other instruments like gold and Bitcoin monetary inflation hedges will actually outpace the paper dollar. So that's a different argument. But that's all about the fact that the US dollar is probably the cleanest shirt in the laundry when it comes to international economies. And the fact is that although the US clearly has fiscal challenges, the US dollar is a major reserve currency and will continue to be so in the long future.
No, absolutely. And I think, well, I mean, we can say that we're already seeing evidence of that, right? Because I mean, we've seen the dollar strengthen at the same time as we've had dollar hit all-time highs, at the same time as Bitcoin seems to be making new highs. So again, it seems like you say, that we're seeing that dollar strengthen together with those other assets, right?
Yeah, and I think one of the factors that one's got to factor in here, which is why I've just put this chart up, is maybe what is going on in the short term with China and what negative effects this could have on the world economy and maybe on commodity markets as we come into 2025. And this is one of the reasons that I'm saying that, maybe one has to be a little bit more prudent coming into 25 than one was at the same point in coming into 2024. 2024 looked to be a pretty nailed on year for strong gains, strong capital gains and risk assets. 2025, I'm a lot more circumspect. There may still be gains, but I think there are some big challenges out there, and this is one of the biggest ones. So what this is basically illustrating is the backdrop for the Chinese economy and or Chinese monetary policy and its impact on the world economy. Now, I've got to explain what's going on here because it's not maybe obvious at first sight. The orange line is a nowcast that we put together, a daily nowcast, which is gauging the temperature of the world economy on a daily basis using a computer algorithm. So it basically feeds in lots of data on commodity prices, credit spreads, trade sensitive currencies, etc. And it says from that data, what can you infer about the tempo of the world economy? And it lines it up to world GDP growth and enables us to actually draw out or pluck out a daily estimate of world GDP. And that's what the orange line is showing. The black line, which has been advanced by 3 months, is the activities of China's People's Bank in their money markets. Now, there's been an awful lot of talk recently about what China is doing or not doing. There's been a major fiscal package announced that's encouraged some, disappointed others, etc.
Mhm.
The main point is not necessarily the size of that package, although that clearly is a factor. It's much more how the package is being financed. And what China desperately needs to do is to monetize to get out of this debt deflationary trap. And
Mhm.
monetization really requires the banks to start buying debt, and it requires probably the central bank to be buying government debt. And all I can say is looking at this data, it ain't happening. Now, what you can see with the black line is that China's net liquidity injections, or the people's bank's net liquidity injections of the markets, have actually gone down quite noticeably ever since that package was announced. And there is something else going on here. And that something else is the strong dollar. And that is causing China an awful lot of grief. China has a notional peg against the dollar. That peg is often challenged, but China has sought to fight that peg many times. And whenever the dollar is strong, China is forced to tighten monetary policy. And that's what they're doing now. Now, that has costs, and the costs it has derive from the fact that China's industrial footprint is giant within the world economy. And if China, effectively sneezes, to use the old analogy with the US, the world economy catches a cold. And that's what's going on right now. And what you're seeing is China tightening monetary policy. And if this chart aligns as it normally does, you've got to start expecting some weakness to occur in both commodity markets and the world economy. And that will persist until there is further stimulus coming, either out of the US or out of China. And it ain't
Mhm.
coming yet, is all we can say.
Right. So we can see that obviously China's hands are somewhat tied due to that peg to the dollar, but what is tying the hands of the US? Because it seems like we're in this conundrum now where basically we have rates that are too high and the dollar that is too strong. So obviously the Federal Reserve wants to have that wants to lower the rates. Of course, what are they afraid of? Are they afraid of the inflation? Is that kind of the two kind of potential risk we're looking at here, either a refinancing crisis or an inflationary crisis? Is that kind of what we're trying to balance here?
Well, as I said, I think the Federal Reserve may work out interest rates again this year. It's possible.
Mm-hmm.
As I alluded to earlier on, I don't think from inflation fighting standpoint that's necessarily a good thing. I think if they're trying to cap 10-year yields, that may have merit, but then they'll be storing up problems for later. So, there's no such thing as a free lunch in economics, as we know. But what this chart here is trying to demonstrate is the rapid the rapid lack of scope for further interest rate cuts. Now, what this chart is basically showing is the black line is a nowcast of the US economy. So if that black line is going up, it's basically trying to measure what we infer, again on a daily basis, the tempo of American business activity. So a rising black line is saying the economy is speeding up. The orange line is taken from the yield curve, it's taken from the cash markets. So this is not Fed fund futures, but it basically is trying to work out how many rate cuts are embedded in the yield curve or the term structure of the cash market. Now, we can refine this a little bit better and we can look at the Fed fund futures. It more or less gives the same direction, but what you see is what you get, and this is the cash market, but it gives pretty much the same conclusion. And the direction is really what's important. So if you go back to September, it looked as if over the next 12 months, the market was beginning to, or was discounting 4 interest rate cuts. What is happening now, ever since that recovery in economic data, is it's barely factoring in 1 cut. So I'm not going to say that you won't get a cut. All I'm saying is this is what the market is sort of deeming is warranted by the pricing of the yield curve. And that would just tell you that in the course of 6 weeks, the scope for significant interest rate cuts in the US has rapidly disappeared. And that's all because of the stronger tempo of the economy. Now, what Trump will do is arguably loosen fiscal policy more, and that will likely warrant, from the Federal Reserve's perspective, it wants to balance things out, particularly against a still strong economy, a tighter monetary stance. So this again is probably consistent with the sort of policies that Trump is likely to engage once he comes in January of next year. So the scope for rate cuts is limited. The potential for the dollar to keep going up is actually quite sizable. And that's that back. If you get a loose fiscal, tight monetary policy regime, currencies tend to like it.
So I'm trying to understand. So you believe that obviously Trump will try and increase the deficit, but then the Federal Reserve will not kind of accommodate that they will actually kind of stand against that?
Well, I think the thing is that I don't think Trump will necessarily try and increase the deficit. I think he'll try and increase spending, and I think he'll try and find ways of saving money if he can to get the deficit down. But I think that frankly, I mean the task is beyond anyone. The deficit is large. The deficit is likely to keep expanding, as far as I can see. There are long-term secular pressures on US spending in the form of aging populations, demographic pressures. Medicare and Social Security are big items. Defense spending has surely got to go up. I can't believe that in a regime, a Trump regime, there will be less, not more defense spending. I think there will be more defense spending. It's probably true you'll get the Europeans, maybe Japan, to help out as well. But the reality is that we're going up to higher percentages of GDP spent on defense. Not going to say there's going to be any escalation of military or any military conflict, but the fact is that geopolitical tensions, are likely to be there, and I'm sure that Trump is going to be alert to that. This is the old adage that strong fences make good neighbours, and I think that that's probably a pretty decent philosophy to operate on. So I believe that all these pressures on spending are going to be there. It's going to be very difficult to rein things in. At the margin, his program, particularly to maintain tax cuts or even improve on tax cuts, will likely, suggest that the deficit gets bigger. And on top of that, you've got deregulation. All these things, investors tend to like. So it's got to be favourable for the dollar.
Exactly. And of course, the idea is also that this is going to be favorable to markets, right? And that's maybe why we've seen some markets rally following the election results. But in terms of narrative for 2025, then, is it possible that something could derail markets in terms of, putting something in our 2025 bingo card? Could we basically see a refinancing event, something like a failed treasury auction, or maybe a spike in inflation? What is it exactly? Because you mentioned, for example, that 2025 could be maybe not such a great year for equities, or more of a more volatile. What exactly are we looking at as in terms of particular catalysts here?
Well, I think if you go through the asset classes, which I was trying to do in the wake of the Trump election victory, I mean, I'd say that you've got to divide many assets up into different attractiveness in terms of their short term and their long term attractions. And I think it's very difficult to come out with any asset class that looks genuinely good short term and long term. I can make a case for bonds looking attractive short term. I can make a case for equities looking attractive short term and not long term. I can make a case for gold looking good long term but not short term, etc. There are very few things that really come out looking good both short term and long term. I think the two of those could be the dollar and TIPS securities, index linked securities, because I think they probably could look good both in the short term and in the long term. But there are few and far between. I think one's got to be more prudent in terms of putting a portfolio together. One of the other things that I think is also worth spelling out, if I can demonstrate, is maybe looking at this chart. Now, this chart is an interesting one to ponder on, and it's not a liquidity cycle. It's basically a cycle in the allocation of all investors worldwide to risk assets. And let me just explain how this is put together. What we do is we look at investment portfolios taken from flow of funds accounts, and we basically work out for each country the amount of money that is allocated to equities, corporate debt, government debt, liquid assets, etc. And we draw up a portfolio that basically says what's the normal allocation between risk and safe assets? Let's call that 0. And then the bands that go up 20, 40, 60, or go down -20, -40, -60, those lines are drawn at one standard deviation above or below, respectively, that mean level. So if you're looking at 20, you're saying that allocations to risk assets are within that portfolio mix across the world, one standard deviation above normal. So you get the idea that what you're seeing here is an active asset allocation of investors moving into risk assets or into safe assets as that line goes down on the page. Now, what I've done is to put a sine wave on that. It's not entirely accurate, but it's not bad. It captures a lot of the movements. Some it doesn't capture, but it, broadly speaking, fluctuates in a different frequency from the liquidity cycle, which is nearer sort of 9 to 10 years. Now, it's always worthwhile paying attention to that. And one of the things that certainly has maybe made me rethink a little bit is that if you look at what's happened recently, the allocation by investors into risk assets, and I'm saying part chain November because we haven't got full November data here, but what you see is the October data, is evidence or some evidence of a rollover in risk preferences. In conclusion, what you see here is evidence of world investors' risk exposure beginning to roll over. So if you think about markets as having two moving parts, one is the flow of liquidity, and the other, which is the allocation of that liquidity into risk assets. What we've got facing us in 2025 is potentially a peaking of the cycle of global liquidity, of money coming into markets. And secondly, from what you can see here, a rollover in the allocation of that new cash into risk assets, so like a double whammy. So it's likely that markets are going to face more and more of a headwind as 2025 unfolds, and therefore we're a lot less upbeat. Let's say we're not going risk off yet, but we're a lot less upbeat than we were this time last year. The old adage is that strong economies don't always have strong financial markets. And now everyone has sort of decided that we're not going to get a world recession, and they're beginning to upgrade their economic forecasts. Maybe it's the time to be a little bit more wary.
Right, of course. Now's the time when we start seeing those comparisons about mentions of soft landing back in 2007, just ahead of the 2008 recession, of course. So, obviously it looks like things are getting a bit frothy, both in terms of risk exposure, obviously, and a lot of people getting very bullish here, and at the same time, maybe liquidity not being as additive. But now let's say from a standpoint of, let's say you had control of all these variables, what exactly would you like to see in 2025 happen so as to maybe obviously support markets? What's kind of the best case scenario here in your opinion of what could happen?
Well, I think the first thing to say is that I think there is potential merit in a lot of the policies that Trump may engage in from a whole number of perspectives. That's not to say I'm a Trump supporter, but I think that if you look at it in terms of deregulation, lower taxes, I certainly vote in favour of those. I think they're positive for economies. So I think from that perspective, things look robust in terms of the growth dynamic. The US economy has been held up, remarkably well by fiscal policy over the last 2 or 3 years, and I think that can continue. We know that the underlying trend of productivity in the US is actually pretty robust as well. So all those factors are sort of ticks for the box. So the US looks in pretty good shape, I think, generally. Europe, I think one has to be a lot more circumspect about, and the fortunes of China really come back to, or the fortunes of Asia really come back to China, and China is not in a good place. So I think if you start to look around the world and you say, well, okay, what really needs to be done? I would say that you need really three things. One is you need pro-growth policies in the US. I would argue we probably got those. I think in terms of China, you've got to find some way of actually resolving this huge debt problem and getting China back on the rails. The solution is very unlikely to be the one that Western economists keep suggesting, which is to enfranchise the consumer and to boost consumer spending, because the Chinese Communist Party is never going to do that. Their model is much more supply side driven rather than demand side. They're producing. Marxism is a system of production, not a system of consumption, and that's basically what you're seeing there. So, in other words, to get the debt problem solved, what they really have to do is to get the exchange rate down significantly, and that's not going to be an easy task. First of all, because it involves great loss of face, and secondly, because I'm sure there would be tariffs imposed, or further tariffs imposed, probably even beyond what Trump is contemplating on China if he decided to devalue the yuan significantly. So I think you've got challenges, but that's what I would say is what's needed. So maybe what we've got to look at a risk in 25 is a significantly weaker Chinese yuan. Which is, plainly a risk that could happen. If that happens, what then transpires for the yen or the Korean won or other Asian units? They'd be under tremendous pressure too. So I think you've got that as one potential problem. I think in terms of financial stability, I want to show you another chart, which is probably going to hopefully explain, if I can, the problem with debt. And that is just showing up here. This is really the key, I think, to understanding how financial markets operate in terms of their, maybe it's the ultimate risk indicator, if you like. Debt has to be refinanced. Many people look at debt relative to GDP, and they use that as a benchmark to say whether debt can be, debt is sustainable or not. And, some very bright academic economists about 10 years ago came out with a conclusion that if the public debt to GDP ratio got above 80% or something, you were likely to see financial crises. Now, I don't think that's actually true. That benchmark is true. Clearly, lots of debt is not a good thing, but the metric of using GDP is not the appropriate one. What you need to do is to look at debt relative to liquidity, because liquidity is telling you how that debt can be refinanced or roll over. And what we show in this chart is the ratio between world debt for the advanced economies, at least, divided by liquidity. And what I've also done is adjusted that ratio for the maturity profile to take out bunchings of debt. And what you see is a fairly stable ratio at about 2.5 times. Now, that's an equilibrium that seems to hold If you go above that equilibrium, so in other words, you see the debt to liquidity ratio being stretched, then you start to see refinancing tensions. So
Hmm.
financial crises are more a much higher risk in that period above 2.5 times ratio. If you go below that, you see a situation of ample liquidity, where there's lots of surplus liquidity washing around financial markets, and that can create asset bubbles. And that's, I would say, plainly what we've seen in the last few
Hmm.
years. Where we've been over that period, really since 2015, is broadly in a regime where the risks of financial crisis have been very low, but the risks of asset bubbles have been very high. And I would say that's been pretty much borne out by events. We're moving into a period now from 2025 onwards where the risks of asset bubbles are less and the risks of financing crises are greater. And that's
Hmm.
clearly a long-term risk. So this really requires some prudence in investment portfolios. Liquidity
Hmm.
is a key factor in our view in terms of what drives risk assets globally. And what we're saying here is we're moving into a period where it's likely that relative to the debt burden, at least, liquidity is falling short.
Hmm. Of course. So that, of course, poses a kind of short-term threat in terms of liquidity. But I guess more in the longer term, then we'd eventually expect kind of basically a readjustment as this in the form of basically much larger monetization by the government. Is that kind of ultimately where this is heading?
Well, I mean, the answer, yes. I mean, the answer is that what you've got to see in the what you will likely see in the long term is debt continuing to rise. And when
Hmm.
we talk about debt in this case, the marginal driver of debt is public sector debt, not private sector debt.
Hmm.
It would be wrong for me to say that private sector debt doesn't matter, because it does matter. But in many cases, it can look after itself rather better than public sector debt. And the problem with public sector debt is that public sector debt tends to build on top of public sector debt. It's never really repaid. So, the interest bill is purely, paid for with more debt. That creates more debt, paid for by more debt. And so you get this exponential growth in debt. And I think you can see that maybe in a chart that I can illustrate. Sorry, I'm going the wrong way. Which I can easily illustrate, which is actually looking at US public debt here. Now, what you can see on this chart is a series of decades in the table, and a chart which is
Hmm.
basically showing the growth rate of US public debt. Now, this is as a percentage of GDP, but the point is clear here. We're in a regime now from the 2020s onwards, where the rate of growth of public debt in the US is every year on average through every decade into the 2050s is somewhere in the 9 to 10% of GDP range. So this is a substantial increase in public indebtedness. Now, if you assume that private sector debt even stands still, that's still an enormous burden for the economy to finance. And what that means is more liquidity. So you're absolutely right. You're absolutely right to say that liquidity will go up as well. And as liquidity goes up, so asset prices are elevated. And so in the
Hmm.
long term, basically do want these monetary inflation hedges, risk assets that will tend to go up with liquidity. But like everything else, it has a trend and it has a cycle.
Hmm.
The trend we've just spoken about, the trend is unambiguously upwards. There's no question about that because of the
Hmm.
rising debt levels. But there is a cycle we've got to pay attention to. We've been in this luxurious situation for the last decade, probably, where what you've seen is ample liquidity on top of a rising trend. We're going to be seeing in the next 5 to 10 years, perhaps, a rising trend, but a cycle that is rather more adverse.
Hmm. Right. So maybe on the short term, like you say, there could be maybe not such great times ahead of us, but in the longer term, you expect that monetization to continue pretty much almost indefinitely, I guess,
Until it doesn't.
until it doesn't.
And we've seen very clearly many episodes through the years of politicians just kicking the can down the road and not doing
Hmm.
anything. And ultimately what happens is that paper money devalues, and it can devalue at a rapid pace or it can devalue at a slow pace.
Hmm.
You just got to look at the purchasing power of a pound sterling or a US dollar note. Today compared with 1924, and you can see that there's been a huge loss of purchasing power over that period. Well, this is basically the effect of monetary inflation,
Hmm.
and we can, if we were able to return in 2125, we may find as well that we're in a very similar situation, that the dollar and the pound, if they still exist, would be a fraction of their purchasing power today. And that's called monetary inflation. That's going to happen. The way you protect against that is getting the right mix of assets. Now, there
Hmm.
are issues in that, because in a world of monetary inflation where asset prices offer some protection against monetary inflation, but high street prices don't, you get massive redistributions of income away
Hmm.
from basically working people towards asset holders. And that is an uncomfortable political situation, as we've seen
Hmm.
many times.
Absolutely. So, two questions there then. First of all, especially in a world where access to monetary hedges like gold and now especially Bitcoin are so commonplace, is there a situation where we could, I guess, how would you call it, reach escape velocity to an extent where even the US dollars, even US citizens are like trying to get away of US dollars as fast as they can in a kind of Weimar Republic kind of situation? And in that case, is there also a policy shift potentially somewhere down the line where we do the complete opposite of monetization, which I guess would be something that has been thrown around by some people, the idea of a monetary reset at some point?
Yeah, I think that, I mean, I find a monetary reset sort of pretty impractical. I don't know how that can be done. I mean, quite honestly,
Hmm.
because you would completely destroy the financial system, which rests on collateral, and collateral is ultimately, debt securities. So, it simply couldn't be done as far as I can
Hmm.
see. I mean, the there are other possibilities. I mean, one would be that you try and discipline the markets by creating a recession. That's not impossible. I mean, in many ways, I mean, the cynic in me would say that this is actually exactly what Trump should be doing when he comes in. He's getting a recession in early and trying to
Hmm.
blame it on the previous administration, a bit like the socialists in the UK did when they came in. They blamed it on the previous Conservative government and said that
Hmm.
they'd suddenly discovered remarkably a black hole in the accounts. That's obviously just a political gesture. There's no black hole, and it just gave them an excuse to raise taxes. Well, why shouldn't Trump use the same playbook? I mean, it's not impossible to argue that. So I think that there's a case for doing something else, like creating a recession. But make no mistake, I mean, we live in a world of cycles, and those cycles are largely, as I tried to argue before, it's all to do with debt refinancing. And debt refinancing is a sort of the paramount issue, in my view, that's driving monetary authorities and fiscal authorities. I mean, that's what they've got to do. They've got to ensure the integrity of the sovereign debt markets. I mean, that's absolutely critical. And I think
Hmm.
everything I see the Federal Reserve and the US Treasury doing is moving in that direction. Just evidence as well what happened in the time of the British gilt crisis after the Liz Truss budget. What we saw was the Bank of England moving with alacrity from QT to QE overnight. These are big issues for governments. Sovereign bonds, the integrity of sovereign bonds is the main thing that they want to achieve.
Hmm. Right, of course, that makes sense. And ultimately that comes at the price of the currency. So of course it's better to hedge against that. And again, unfortunately, it can create those disparities, I guess, where obviously you're kind of redistributing wealth to an extent between those people that can or are hedging against these things and against those who can't or aren't. But
Yeah.
so we've covered most of the assets. Is there anything else in particular that we've missed out on? Obviously, quite bullish on monetary hedges like gold and Bitcoin. Equities in the short term, not so much, but generally in the long term, yes. Um, Anything, for example, with the outlook for energy, which, is kind of an interesting topic now. Also, maybe with AI kind of increasing the demand for energy. Any thoughts on any other particular asset classes?
Well, I'm not an expert on AI. I wouldn't profess to give any recommendations. I think with regard to oil, the oil price is very much geopolitically set. There may be a case for saying that oil prices could, fall in the short term. It may well be that Trump wants to sort of exercise some power or influence over the Saudis and show that he's, on friendly terms. Maybe there'll be a gesture in the direction of lower prices. I don't know. I mean, that's pure speculation. But I think it's a geopolitical factor. I think that, at the end of the day, what's the bottom line here? I think there are two bottom lines in a way. One is that you've got to remember we live in cycles, and so you've got to invest with some knowledge or some appreciation, let's say, of where we are on the cycle. And I've tried to demonstrate that we're coming towards the end of a cyclical phase. It hasn't changed yet, but we're approaching that sort of inflection sometime next year. So we've got to try and plan for that. You need this context to invest. And I think the other thing to say is that we live in a world of monetary inflation. And that monetary inflation world is really dictated by the fact there's huge amounts of debt. We have this debt fixation. We're all hooked on debt, whatever stripe, whichever country you look at. Debt is used as the main financing vehicle increasingly. And that was really evident in the wake of the 2008-9 GFC, again reinforced by COVID. Debt is the solution. Debt needs liquidity. Liquidity means monetary inflation. And monetary inflation ultimately needs hedges like gold or Bitcoin. And, the sort of maybe the final thought is to say this. Look, since the year 2000, US debt, the stock of US debt has increased by 8-fold. The price of gold has gone up by 8.25 times. So gold has matched the increase in US debt. And if you think US debt is going to increase by another 8 times in the next 25 years, the price of gold will do the same.
Mm-hmm. Absolutely. Well, there you have it. I think you can't argue with the numbers, and definitely a good opportunity to buy gold on the dip now that it's at least retraced a little bit, probably, right?
I think that's right. I think that's right.
Awesome. Well, thank you so much for coming on the show, Michael. Again, I find your insights absolutely invaluable. For anyone wanting to follow you and keep on top of these cycles, where can they find you online?
Probably the best way is Substack, which is called Capital Wars, after the name of a book I wrote a few years ago. We've got a Twitter handle, which is @CrossborderCap, and we've got a website for institutional investors, which is www.crossbordercapital.com. So those are the three easiest ways, I think.
Mm-hmm. Absolutely. Yes, thanks again, Michael. And again, to anyone listening, please do yourself a favor and go check out Michael's work, because it's absolutely invaluable. So again, thank you, Michael, and hope we can do this again in the near future.
Great pleasure. Thanks again. Thank you.
All right. Bye-bye, everyone.